Hello friends, I'm Vijay Bambwani and believe me when I tell you this, please take me at face value. There's some very serious stuff happening in the market right now and this video is quite possibly the most detailed, most critical video that I've ever made on this YouTube channel. I would sincerely request you to stick to me till the very last minute of this video because there is a special segment in this video. If you're familiar with YouTube video chapters, that chapter is titled Special Report. Skip anything else you feel like, but do not skip the Special Report segment. So let's dive right in, and what you're seeing on your screen is the market roundup window. Are you really surprised if you've been with me on my YouTube channel for long to see that the Bank Nifty has underperformed the Nifty 50? Do remember what I've told you? It's only the naive and the newbie traders who ignore the bond market and interest rate signals before trading the Bank Nifty. And there you have it. The Bank Nifty has taken a bigger knock than the Nifty 50. Bullion fell because the USD was showing great deal of strength. Do remember the dollar is the invoicing currency in the global commodities trade. And if the dollar is up, commodities tend to be down. But energy, crude oil and natural gas prices were higher and they're going to be a worry for this market. The US dollar index rose 0.43%, but the US dollar versus the rupee rose by 0.54%. Now, this is the crux of the worry here. So far, the rupee was falling against the dollar much less than the dollar was rising against the global basket of currencies. Now that's reversing and that is a concern. I'm going to come in great detail in the special report at the fag end as to why. The 10-year benchmark bond yields shot through the roof at 7.44%, and there are some state government bonds which are now actually offering you over 7.75%. I've talked about this in my previous videos as to why this is a worry. Cost of funds are likely to rise, and with interest rates rising, the era of cheap money is coming to an end. Do remember, cheap and easy money is mother's milk to a bull market, and now that cost of funds is going up, you should not be surprised that the stock markets are coming down. The NSE lost more than 4% in market capitalization on a week-on-week basis. Now, this is a very huge concern for me. As far as I'm concerned, if you're going to lose 4% in the entire market cap in a week for more than 2 to 3 weeks, you're at a great risk of entering a bear market territory. I'm not saying that we are there yet. This is the first week where we've lost more than 4%. Believe me, I've been trading these markets for 36 years now, since 1986. And I can tell you with a great degree of confidence, because I keep statistical data of the market, whenever the markets have fallen more than 4% in market cap for 3 consecutive weeks, the probability of a bear market beginning are significantly elevated. Now, the US markets, what you are seeing is the overall market in the US has declined, although the velocity and the amplitude of the decline may not be really very significant, but the fact remains that the cues coming in from the overseas markets are anything but positive. Now let's see the chart of the Dow Jones Industrial Average. You're seeing a death cross here. A death cross is when the 50-day moving average falls below the 200-day moving average. The 50-day moving average is a 3-month holding on cost of an average buy and hold investor. 200-day average is approximately a year-long holding on cost of a buy and hold investor. So whenever the 3-month average buyer is witnessing his price go below the annual holding on cost guy, also selling pressure emerges. Now the Dow has recently triggered a death cross. But take a look at the chart of the Nasdaq 100. The death cross occurred in early March, which is why your technology stocks in India are falling. No surprises there. The US market has basically shown a higher probability of entering into a bear market territory. Now, the last entrant into the death cross brigade, the S&P 500. A very, very broad-based index, like the name suggests, S&P 500. Now, this index last week has collapsed into death cross territory. Now, these birds ain't flying high in a hurry. No, sir. So, the overseas cues are likely to remain negative. Be very, very alert. I now take you to the MWPL chart, the market wide position limits. Now, this is a risk appetite gauge of the two marshmallow traders. You'll find the Marshmallow Theory in this video, the thumbnail which you're seeing on your screen. The hyperlink to it will be in a pinned comment below, in the description below the video, and in the end screen of this video. Don't worry, we've got you covered. The MWPL has been rising, which it does till the third week of any derivative is expiry, but the rise has been coming rather tepidly. Gone are the days when we've seen 32, 33, 34%. Nowadays, MWPL peaks out at 28 and 29%. So the two marshmallow guys aren't really sinking their teeth into the stock market and buying aggressively. The same thing is showing up on the weekly chart on your screen. We've seen a decline in the expiry week to 20.46, which is marginally lower than the previous expiry in the month of March. But definitely risk appetite seems to be easing off. Now let's see the index and individual stock futures turnover. This is cumulative data of 3 derivative concurrent expiries. So May, June, July. What you are seeing is that index futures turnover has fallen very marginally, whereas individual stock futures turnover has risen. Now that, if you ask me, is a concern. Why? Because the one marshmallow traders, the guys who are intraday traders, are preferring to trade in individual stocks, which are at least gyrating where statistical beta or pure price volatility is concerned. The individual stock category has a volatility of at least 50% higher than individual stock indices, I mean. So if traders are beginning to feel comfortable trading higher volatility stocks as compared to low volatility indices, which means they are preparing to sell. And if traders are comfortable selling, markets will fall. It's as simple as that. The same thing is being confirmed by the weekly chart of the index and stock futures turnover of 20 weeks in duration, that is 4.5 months. You're seeing index futures turnover is tapering off, whereas individual stock futures turnover picked up a little, in spite of the fact that the week gone by was shorter by one trading session. Let's now see the prompt month futures, Nifty and Bank Nifty basis. Basis is nothing but the premium enjoyed by futures over spot. This is somewhat similar to the options premium being high in the beginning of the cycle and eroding and decaying as expiry comes closer. See how week on week basis the premium of both the indices has come down. And do remember, this is pretty early in the expiry, yet we only in the second week. The premium enjoyed by futures should have been higher. What worries me is that the Nifty basis is now 8 rupees only. Should it go into inversion? By inversion, I mean negative zone, when the future is trading below spot, beware. This could be a cue that the bears are going to attack the Nifty. So watch out for inversion. Do connect with me on social media, my friends. I update all this data that you're seeing in this video on a day-to-day basis on my social media accounts. My contact coordinates will come at the fag end of this video. So do stay in touch with me. Let's help each other become better traders and get our business going. Now the basis chart on a week-on-week compression for 20 weeks, 4.5 months, what you are seeing is that the one marshmallow appetite is down to almost the lowest in 4.5 months. This is in the lower end of the range. See how people are paying less and less premium to trade in futures, which means they've burnt their hands, they are losing money on their long positions, and they are unwilling to buy more. This is another red flag. Let's now go to something that I've introduced to you, a very, very simple metric, advanced decline ratio. The number of shares gaining versus the number of shares falling. In all 4 days last week, not even one day did you see the ratio go to 1:1, which means the number of losers were always higher than the number of gainers last week. And what we are seeing is that we are now at the lower end of the 20-day range that we are seeing. Does the weekly chart tell us anything different? Not at all. On a weekly closing basis, also, we are at the lowest point in 4.5 months closing on a Friday. And that is an extreme worry. What you are seeing is that for 3 consecutive weeks, the advanced decline ratio has been constantly sliding, 0.59, 0.49, and now 0.23. Friends, this is another red flag. Now let's see the impetus chart. The impetus is something that you've loved, you've respected, you've accepted, and you swear by. So do I. So do I. Look at what's happened to the impetus chart on all 4 trading sessions, or at least the last 3 trading sessions. The impetus has shot up. And guess what? In the last 3 trading sessions of last week, the market has only fallen. Remember my warning in last week's video when I told you that the impetus is now at a multi-month low. Don't celebrate, because you're going to see the market, which is now currently coiled like a compressed spring, suddenly spring to life, and volatility will jump to your surprise. And look what happened. The impetus was bang on. It was so prescient, it was so prophetic that not only did the volatility go up, but now the indices have fallen with rising impetus. Now the bulls are really, really into a corner. Let's see on a week-on-week basis where the impetus chart is. A sharp jump. Sharp jumps from extremely low readings, which tells me that the trouble for bulls is not yet over. The fact that the indices have fallen off sharply and the impetus has jumped to a few weeks highs tells me that the bears are now smelling blood. Let's now see our latest indicator that I introduced you to, the LWTD, or the Lift Weight Thrust Drag Index. The index is very well explained in a completely a unique video, a separate video. The hyperlink to the LWTD indicator is in a pinned comment in the description below this video and in the end screen of this video itself. Note how the Nifty gain-loss percentage line indicated by a blue line is in the negative, and the LWTD on Friday is also in the negative. Not much, but 0.10 negative. That tells me that even if the markets were to attempt to rise, there would be selling pressure on advances. So there are very, very slim chances on a daily basis, that is purely on Monday, for the Nifty to close in the green. Extremely rare. Maybe some unexpected good news comes in, the war in Ukraine ends, or there's a miracle, maybe then, but otherwise the bulls are going to find it laborious. What about the weekly chart of the impetus? I mean the LWTD, sorry. Now the LWTD shows that the Nifty has fallen lower as indicated by the blue line, whereas the LWTD is attempting to flatline. That means the markets are attempting to resist falling too much. But do remember, in spite of the fact that the markets attempted to resist falling too much, the Nifty market capitalization lost more than 4%. That tells you how hard the bulls have tried and how badly they have failed. Should the LWTD on a daily chart continue to fall, believe me, you have a humongous problem on your hands, my friends. So please stay with me connected with me on social media. The LWTD chart is also something that I update every night on my social media accounts. Don't lose track of this indicator. This is a lifesaver as far as I'm concerned. I bet my company's prop trading money on this, and I believe I am vindicated in what the signal tells us. Now, friends, I take you to the footprint of the four different categories of traders in the markets. I begin with the FIIs. The FIIs have increased their net longs in stock futures, which is indicated by a red arrow. This is showing their outlook more than the numbers. But where the index futures are concerned, their outlook seems to be a tad more bearish. They've increased their net short positions. Take a look at DIIs, the domestic investment institutions. They seem to have increased their net short positions in both the index and the stock futures segment, which is why both blue and red arrows are pointed downwards. Now for prop traders. Now these are super sharp traders, brokers own proprietary trades. They are second best to the insider traders because they know who's buying and selling how much because their orders are executed through them. They've been raising their long positions in both the index and the stock futures, which is why both arrows are up. Do these guys know something that you and I don't? The coming week will tell, but prop traders are buying. Now let's take a look at what the retail guy is doing. Do remember, it's the retail segment which has fueled the rally this far, and they've done all the heavy lifting. Now the retail segment has shown optimism in the index futures space by raising their net long positions, but in the stock futures space, they are unwinding longs. And by the very sheer size of their open interest, do remember 13 lakhs 2,993 lots. If even 10% of these positions were to get unwound in a trading session, I assure you, the very weight of selling of the retail segment can cause damage to the market. So the market is now completely dominated by retail players, and these, unfortunately, many of them are newbies. They've not seen what a bear market is like, so market is in weak hands right now. Friends, I now come to the bond market space. I have no hesitation in saying that we were early on the block to analyze the bond yields and their signals for the bank nifty and the overall market traders, and the others are just playing catch up with us now. So the bond markets, I have been warning you, are telling me that they are expecting A, higher inflation, or B, higher interest rates. And there you have it. The RBI governor simply raised interest rates in a sudden move, 40 basis points increase in repo rates. And that very night, the US Federal Reserve raised rates by 50 basis points. So cost of funds is going up. That is reflected in the chart on your screen, which is the RBI 10-year benchmark bond yield. And we are now close to 7.5%. I have told you that I have been deploying my family's money in sovereign debt and somewhat in bonds. So the GS 2035 bond, which I have talked to you about in my earlier videos, remains a good investment. I'm also looking at a few state government bonds, but nothing that appeals to me or something that I feel very tempted to buy right now has come to mind. I assure you, I will share more data with you as and when it's made available by market opportunities. And do remember, trading bonds is free on RBI's retail direct website. You're trading directly with banks, 100% government guaranteed funds against 5 lakh rupees guaranteed by your bank FD, and that too at interest rates that are fetching at least 1.5% lower yields. So I don't see any reason why people would want to invest in fixed deposits when you have such a beautiful window out here. But do remember that the cost of funds is rising, and that is going to give heartburn to equity markets because mother's milk to equities market is cheap and easy money. And the days of cheap and easy money are nearing an end. So the big ticket check writers have been getting a raw deal by zero effective interest rates, which is inflation adjusted yields from fixed deposits. And they are now showing signs of stopping writing new checks, which could cause a liquidity shock to the market. All right. So the only way out is to raise interest rates or print money, and you know what's happened after we printed money, or the US has printed money: inflation. So there is a better way to provide liquidity in the market, and that is to encourage an average Joe to write out checks so he invests in the bond market. But hey, the guy wants higher interest rates and he's going to get it, which is why the equity markets are going to be somewhat subdued in the year 2022, because funds are going to flow out of equities and somewhat into debt markets. I've already started laddering bonds. I've been telling you for many, many months that you should also be laddering bonds. I'm very happy that many of my friends on social media have come back and told me, Vijay, we've started investing in bonds after you've told us trading is so easy and direct without any commissions and costs. So all the best to you guys. Friends, the bond market's done. I now come to the US dollar index. This has been a cause of concern. Do remember, emerging markets, including India, are net importers and nurse a lot of overseas debt in US dollar denominated. Now, when the dollar goes up, the lesson that I learned in the 1997-98 currency crisis was our interest payments and repayments of loan become a lot more difficult because the rupee is weaker against the dollar. Now, on your chart, on your daily chart on your screen, what you can see is that the US dollar has gained, the Dixie rather, the US dollar index rather, has gained 0.43%, and it has risen on 2 out of 5 trading sessions. But on Thursday, the kind of gains that it logged has ensured that the Dixie has closed in the green. Otherwise, falling on 3 out of 5 trading sessions, the probability was that it would have lost week on week. But why was the Dixie rising? Because the US Federal Reserve increased interest rates, and that will trigger cash carry trade, where people will take money out of lower interest paying economies and put it into US because the US interest rates are rising. 3 things will happen. Number 1, inflow of money in US, the dollar becomes strong. Number 2, US inflation goes down because all imported goods now become cheaper because the dollar is stronger. And number 3, other rival economies like England, France, Germany will be forced to raise interest rates. Now you see why rising interest rates will lead to even more rising interest rates, because people will want to attract the cash carry trade investments. So if you have an interest rate higher than the US, money will leave US and come to your country, hypothetically, which is what France, England, Germany will try to do now. So you can imagine how worldwide interest rates will rise because people will want to attract FDI or foreign direct investment, and equity markets are not going to like it. Just as simple as that. The price on your screen is showing signs of staying stickily above the 25-day exponential moving average, which is a proxy for month-long holding on cost of an average bull. So the short-term outlook remains optimistic for now. Let's take a look at the weekly chart. The price is running significantly higher than the 25-week exponential moving average, which is a proxy for a 6-month holding on cost of an average bull. So the medium-term outlook also remains positive, although there could be possibilities of some profit taking, but that's just about it. So as long as the dollar remains firm, my friends, I think emerging market economies and their stock markets are likely to remain under pressure. And last week, I advocated a range between 104.65 on the upside and 101.80 on the downside, which was exceeded on the upside because the US dollar index actually made a run for it on Thursday. In the coming week, I expect a range of 105.20 on the upside and 102.20 on the downside. Friends, the dollar index done. I now come to the bank Nifty, the second most liquid derivative traded counter on the NSE derivative space, and it fell 4.15% on a week-on-week basis. And are you really surprised? Because I've been coaching you so much about the bond markets, its impact on the bank nifty, the impact of inflation, the impact of the US dollar. Let the other traders fumble, stumble, and try to find their way. You are far ahead of them, which is what my videos are all about, to keep you ahead of the crowds. And that's my promise. These videos will remain free. My indicators will remain free of cost. And I'm going to help my friends stay miles ahead of the crowds. Let's now jump onto the daily chart on your screen, which shows the Bank Nifty fell on 3 out of 4 trading sessions. And the last trading day of the week, the Friday, was a slam dunk gap down open and a sharp fall. The price is below its 25-day exponential moving average, which is a proxy for a month-long holding on cost of an average bull. The average itself is falling, which means the buy and hold traders are extremely nervous and they are sweating under their collars. And turning now to the weekly chart, what you can see is that the Bank Nifty is headed towards the low that it made in the month of June 2021. Can you imagine the plight of traders who have bought and rolled over their long positions for say 8 to 10 months now? Not only are they losing mark to market in terms of payouts, but they would have also incurred cost of carry or financing cost to roll over their position from one month to the next. Now, unfortunately, this is something that doesn't show up on the technical analysis charts, nor do your so-called experts tell you when they tell you to go long and sit on your long positions, because you as a trader in the real world know that your cost of carry will keep on adding weight, dead weight. While you swim in the ocean, it's like carrying a weight on your back. That's not really very welcome. So the price is below its 25-week exponential moving average, which itself is sloping downwards. That tells you that even the medium-term outlook for the Bank Nifty is now turning weak. And this coming week at least, I would expect that the market will experience sell-on rallies on the Bank Nifty. Anytime the Bank Nifty attempts to go towards the 37,000 odd, which looks stretched, of course, but that's where a lot of people are waiting in the wings as per my statistical analysis to break even and exit. Now, this panic driven selling at higher levels is called overhead supply. Trapped bulls trying to exit. So the coming week, the market is likely to see a lot of overhead supply. Now, in the week before last, this index was at number 9 on the most volatile counters list. But now I'm worried about this. It's jumped 5 notches to go at number 4 of the most volatile counters list. You know, a big index being number 4 on the most volatile counters list, that means traders' life is just turned to hell. All right. And last week, I advocated a range between 37,850 on the upside and 34,300 on the downside. Note how the low made was at 34,353, which is just 53 points higher than the support that I gave you. 53 points on the Bank Nifty, which is trading at 35,000 odd levels, is beautiful. Now, this is why I basically tend to give out ranges based on our statistical trading model, the IBEX. Although I've been asked as to why the range is narrow one week and it's broad the next week. Hey, that's the base effect kicker that's coming into our calculation. So, in the coming week, I expect the upside range to be on 36,375 and downside 32,800. Outlook still remains under pressure. Friends, I now take you to the Nifty 50, the most liquid, low impact cost instrument on the National Stock Exchange derivative space. Now, this index lost 4.04% on a week-on-week basis and fell on 3 out of 4 trading sessions. Like the Bank Nifty itself, it fell with a sharp slam dunk gap down on Friday, as you can see on the daily chart on your screen. The other thing that you will see on your screen is a very thick, bold red line I have connected the peaks with. What do you see? That line is sloping downwards. What does it tell you? That the peaks are falling. It's a lower tops market. And if you see the bottom made in December, the following March, the bottom was much lower. So not only was the top falling, the bottoms were also falling. What if, this is a hypothetical situation, what if the falling tops formation where three tops are lower subsequently, progressively, what if the falling bottom theory was also coming to effect? Which means you're looking at a breach of 15,600, 15,700. I'm not saying that it's happening. All I'm telling you is what if. Which is why I've been cautioning you on social media to be extremely careful. Trade light, trade light, trade light. Now, some guys don't like that. They ask me, Vijay, why do you want us to trade light? Hey, the statistical beta or the pure price volatility is way too high for an average retail investor to handle. The price itself is below its 25-week exponential moving average, which by itself is falling. So the buy and hold investor is very clearly sweaty under the collar. The weekly chart of the Nifty itself is telling you that the 25-week exponential moving average, which is a proxy for a 6-month holding on cost of a bull, has now slightly fallen, and it basically is showing signs of weakness. The price is at multi-month lows, so the average buy and hold investor is clearly in trouble. Friends, in the week before last, the Nifty was number 16 on the most volatile counters list, and it's risen 3 notches to number 13 last week, which again is a sign of concern, which tells you that if volatility is rising, the job of an average retail day trader is becoming that much more difficult. Last week, I advocated a range between 17,725 on the upside and 16,450 on the downside. It was violated, I admit, and it made a low at 16,341. And this is something in my own defense, I will say. I warned you last week in the video that statistical beta is high, and there are very fair probabilities that the ranges might just be violated. So in the coming week, I expect a range between 17,050 on the upside and 15,750 on the downside. Am I trying to cover my ass by giving you a very wide range? Not at all. It's a function of statistical beta, and the beta is way too high. So if you try to get too aggressive, chances are the market might chop you both ways. And those of you who've been with me long enough know that I use a lot of tools used by hedge fund managers, because I, at some point in time in the near future, aspire to have a hedge fund of my own in-house for my family. I swear by the Jensen's measure and the Traynor ratio. And believe me when I tell you this, both these ratios are screaming caution. They're deafening. They both are deafeningly screaming caution, and you should be paying attention. So trade light, hold your trades with stop losses. Friends, I remind you again, there is a special segment in this video, so please don't go away. Stick around to the fag end of this video. The indices done, I now come to the most popular segment of this video, wherein I give you 5 stocks which are high beta, high impetus, and 5 stocks which are low beta, low impetus. Why? I recently made a video which, thank you for making so popular. I told you I look at a metric called the trade efficiency ratio, wherein how much money do you take home after your trading costs, commission and taxes. As a veteran trader, I want my trade efficiency ratio to be 3 plus. So if I'm taking 3,000 rupees net of all execution costs, commissions and taxes, and those cost, commission and taxes are equaling 1,000 rupees, my TER or trade efficiency ratio is 3. That's when it gets satisfied. All right. So if you want a high TER, do watch that video. And the list of shares that you, my viewers, are asking me to give you of high impetus stocks every day. Here it is on your screen. This list will suffice from Monday, and from Tuesday onwards, you're going to be receiving this list via WhatsApp. So if you haven't already done so, do send me a message on my WhatsApp number. It will come at the fag end of this video in the contact coordinates, also in the description below this video itself. So this feature is completely free. Do feel free to recommend your friends, family and relatives. And now plunging into the high impetus stock list, we have Voltas at number 1, Dixon at number 2, number 3 Titan, number 4 Naukri, number 5 PI Industries. Now low impetus stocks where you take high exposure and wait for small price moves, which is for scalping. Very, very small gains multiple times a day, led by Jubilant Food, LTI at number 2, number 3 Chambal Fertilizers, number 4 Colgate, number 5 ACC. Now friends, volatility compresses and expands hour to hour, day to day. So this list is bound to change every day, which is why I'm going to WhatsApp you with this list on a day-on-day basis. The list that you just saw is okay for Monday. Tuesday morning, you'll be receiving a list for Tuesday's stocks. Now, my friends, I promised you that I would be recording a special segment on what I think is worrying the markets from my point of view as a 360-degree worldview trader. So on your screen, what you are seeing is the first worry that the markets are going to experience in the coming week is high energy costs. Now, crude oil and natural gas are multiplier commodities. When their cost goes up, everything from food, transport, clothing, medicines, etc. start to move up. This will create a broad spectrum inflation. That's worry number 1. Worry number 2, the rising dollar is triggering fears of imported inflation. Remember, everything that we import, and India is a net importer since independence, will become more expensive. And 2/3 of all our imports are fossil fuels, hydrocarbons, natural gas, crude oil. Their landed cost becomes higher. So A, the price in overseas markets is as it is higher. B, your imported inflation caused by a rising dollar and a falling rupee is making inflation worse. And what is the worst kind of inflation? Food inflation. Why? Because the demand for food is non-negotiable. You cannot say, I'm going to skip my meal for 5 days and save some money. What you will skip is buying a new pair of shoes or a new pair of jeans. So people will buy food first. And because it's getting so expensive, they might put off purchases of other things, which is what corporate India is worried about, which is what the stock market is worried about. Number 3, easy money. Like I told you in my video earlier, is mother's milk to a bull market. Easy money fueled this rally, and now the cost of funds are rising. The big ticket check writers are saying, okay, I'm not going to write any more checks unless you give me positive returns adjusted for inflation, which is real effective interest rates. Now that cost of funds is rising, the mother's milk to a bull market is slowly being turned off. The taps are closing. That's the best thing I can tell you. Markets know that. Smart money knows that. Worry number 4, overseas markets are appearing weak, and emerging markets, including India, get concerned when emerging markets, like I said, like India, get concerned when the US markets start to get nervous. Remember, all 3 indices, the Dow Jones, the Nasdaq and the S&P 500 are now entered a death cross territory. They can plunge any time. Worry number 5, NSE lost 4% and higher in market capitalization on a week-on-week basis. Like I told you, history has proved that whenever this has happened in the past, it's not really been turning out well for the bulls. So I think you need to be extremely careful and monitor all these aspects. And lastly, this is another aspect. You might you might think I'm repeating the dollar aspect. I'm not. Now I'm talking on the rupee. So far, the dollar was gaining. Now the rupee is falling. Are these the same thing? Not at all. They're two different things. So far, the dollar was gaining in the US basket of currencies, but the rupee was falling less than the dollar's percentage gain, which means the rupee was outperforming the dollar. Now, the rupee is heading towards a lifetime low, which means now there's more pressure on the bulls. Cash carry trade. Remember, India is attracting a lot of foreign portfolio investments due to interest rate arbitrage. So since interest rate is low abroad and we are offering a higher rate, people were taking money out of low interest rate economies and putting it into India and hedging their currency by going short on the currency peg. But now that the currency is turned weak and the interest rate in the overseas markets have started rising, that is coming under threat. And the balance of payments, of course. India, being a net importer, will need dollars to pay for its imports. And that is a worry that the markets are feeling, and that's what it's showing up on my screen. Now, friends, this special segment would not be complete unless I gave you a guidance on which sectors and which stocks are appearing weak. So that is something that I have prepared a short list about, and what you are seeing on your screen is the first category, interest rate sensitives. Any company that has taken a lot of loans and is completely leveraged, and even a 0.25% or a 0.5% rise in interest rate will make a huge difference to its profitability, will see its share price coming under pressure. Market analysts continuously monitor the gearing ratio or the debt to equity ratio, and companies that have a huge amount of debt will see their stock prices fall very rapidly. Number two, companies that import their raw materials but sell their finished goods in India. Remember, raw material prices are going up thanks to a very strong dollar. Now you have a rupee which is weakening. So even more imported inflation for your raw materials. And since you're selling your goods locally and not re-exporting them, the local players might buy cheaper alternates. So your sales might fall. That's another category of stocks that will fall. Number three, plastics, polymers, adhesives. By adhesives, I mean gums, resins, your Fevikwik, Fevitite, whatever, Quick Fast. These companies have their raw materials from petrochemicals, oil-based products. Now, oil prices are going up and so is the dollar. So there's a double jeopardy, double hit to their raw material costs. And these stocks can come under pressure because the input costs are soaring. Companies that are heavily dependent on EMI-based sales of their products. Look around you. How many people are buying cars, commercial vehicles, trucks, tempos, passenger vehicles, two-wheelers, color TVs, air conditioners, refrigerators, washing machines by making down payments? How many NBFCs have their desks in supermarket and they are offering you easy EMI loans for all your purchases? Now, companies that are dependent heavily on EMI-based sales to push up their top line will see their bottom line getting hit, and the markets know it. These stocks are getting punished and they may continue to get more punished. White goods companies, which I told you, air conditioners, washing machines, LED TVs, passenger vehicles, commercial vehicles, two-wheelers, and allied industries, mobile phones also to a certain degree, will see their EMI-based sales falling. Now, these companies are something that you need to look out for. Last but not the least, and the most important one in my humble opinion, NBFCs. Because they borrow money from institutions and they take fixed deposits from retail investors to arrange working capital, they will find their cost of funds go up very, very sharply. And the other is oil-based paint companies. There are water-based paint companies and there are oil-based paint companies. Oil-based paint companies are also using petrochemical-based raw materials. Their input costs will shoot up. And these stocks are something that you should be staying away from, not buying right now. Friends, I hope you've found value in this very detailed and admittedly long video. Like I said, this is the most detailed video that we've ever made on this YouTube channel. And I hope I can save you losses and earn profits for you by sharing more and more statistical inputs from our in-house statistical model and behavioral models. And you're going to be getting a lot more WhatsApp messages from me in the coming week onwards. Before I sign off from this video, my friends, a request. Please subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts. Good, bad or ugly, I'd love to have your feedback in the comment section. And please share my video with smart people like yourselves to help them take more informed decisions so that I reach out to a wider audience. I thank you for your patience and sticking with me in this long video till we meet in my next. This is Vijay Bambwani signing off for now. Have a very profitable week ahead. Bye-bye.